Hi, Matt McAleer, President, Director of Private Wealth. May 23rd, just after the close. Heading into a 3-day weekend, want to tip our cap to those who gave their lives to our country. Always important to raise a glass for them. We head into summer season. Memorial Day also tends to be a big barbecuing day. I wanted to share a funny chart put out by Dorsey Wright today. It goes hand in hand with our Benjamin Graham quote from last week about extremes in the market going from extreme exuberance to irrational pessimism and back and forth. Take a look at this. It's pretty funny. It's in the event of a advisor being invited to his neighbor's backyard barbecue and what that may mean for market direction. I love the first one. Your best friend and neighbor has a backyard barbecue to which you are not invited. That means the market is at a bottom. Call all your clients and tell them to buy if anyone will answer the phone. Market just had a 6% reversal to the upside from below the 30% level in the bullish percent indicator. I won't go into that indicator now, but what it does is try to track extremes in buying and selling pressure. You've heard me mention it before. You've heard me mention extremes and momentum. So just important to look at certain things like that. It wasn't more than 6 weeks ago that we had real pessimistic extremes in momentum. We saw less than 10% of the stocks on the NASDAQ and the S&P 500 exhibiting positive momentum. When we get to that point, when greater than 90% of those securities are exhibiting negative momentum in our analysis, it's time to push a little money in, gamble a little bit. The other side is also true. When we get up to that 80% plus momentum level, in other words, 80% of the stocks on the New York Stock Exchange or the S&P 500 are trading with positive momentum in the way we calculate it. That means it's probably time to take your foot off the gas a little bit. An awful lot of capital has been used to get that momentum number to such a lofty level. And that's where we were late last week, early this week. So this little pullback, S&P down 2.5% this week, it's as natural as rain. You need to reset. You need to maybe inject a little bit of fear back in the market, create some entries. So we'll probably see that over the next couple of weeks. You know, we've been fairly consistent that when the first 4 months of the year are negative, historically, we have quite a bit of volatility the rest of the calendar year. Again, that doesn't mean you can't make money. It doesn't mean that the indexes or certain industries and sectors don't perform wonderfully, but they do it in a more volatile atmosphere. And I think that's what we'll continue to see at least throughout the summer. Pick and choose your spots. We start to get into that point where we have levels that we want to commit at, and we'll have bids at levels that we want to commit at. And the areas that continue to work, maybe not this week, but continue to work are industrials, financials, consumer discretionary. Going to be volatile. There's going to be nasty days and nasty weeks. Just have levels that you're confident you can make money at 6 and 12 months out. So these higher interest rates, and I'm sure John will discuss them in a few moments, these higher interest rates do pressure equity valuations. So when we saw a 5.10, a 5.11 on the 30-year, you saw some money start to leak from the equity market. Probably will continue to do so. The 10-year in that range. We can't break out of that range. Do we? Sooner or later we will. But 4% on the 10-year is kind of our low target. 475, 480 on the 10-year, our high target. Unlike others that may use momentum to try to follow a market, we use those as counter indicators. When we start seeing 475, 480, 485 on the 10-year in bonds, we're going to be buyers when we start seeing 410, 405, 395. Want to be sellers there. Want to take a little off the table. So it's not just equities that you can add and dampen in terms of positioning. Bonds as well. So John and Ben have been busy. But in terms of next week, we have some economic data coming out that could move the markets. Let's watch currencies and let's watch the 10-year bond. That's really what will dictate the short term. We'll try to look through the short term, look through some of the valley, and get good entry spots for any cash in the portfolios. Enjoy the weekend. The Moose is next.
Hi, it's John Musso. I'm the Chief Investment Officer at Cumberland Advisors. It is Friday morning around 11 o'clock on May 23rd. We hope everyone has a great Memorial Day weekend. Getting out of town at Sarasota Airport, busiest airport in terms of growth last year. So fastest growing airport in the country. Just opened up a new terminal here. So it is flush with people. And you know, what's interesting about the airport is it has no debt, which allowed the airport to make a lot of improvements during COVID in terms of attracting a lot of airlines with new direct routes. So if you haven't come to Sarasota, it's a great spot to visit. This week in bonds, you saw, you know, Treasury yields down 448 to 446 on the 10-year, but it doesn't tell the story. It was up as high as almost a 460 as of yesterday, and that drift up was almost entirely due to the thoughts and more the uncertainties of the budget that arrived on the president's desk. You know, with obviously the spending that goes along with it. Today, however, what did you see? You saw yields come back down. Why? Again, the president talking about taxing the EU with tariffs, talking about Apple having to bring their manufacturing into the U.S., clearly not helping the stock market today. So listen, when there's uncertainty, we've talked about it before, people run to the safety of U.S. Treasuries. Today is no different. Muni bond yields this week, up, 327 on the 10-year muni, up to about 337. So 10 basis point drift up. That doesn't reflect where you're going to be today, because those yields will come down a touch today. But the real good story about munis is that deals well oversubscribed for, good participation, inflow into bond funds, and more importantly, as the tax bill reached the president's desk, there is nothing in it about taxing munis. So as we've talked about many times before, you know, after all the different machinations, there is no tax issues with munis, and we think that's a great thing. Certainly there's a lot of infrastructure to finance, and municipalities who are experiencing slowdowns like other parts of the economy will need to use the debt markets in the next few years. Hope everyone has a great weekend. We'll talk to you next week. Thanks a lot.
John on the road again. Appreciate it, Moose. See you next week, everybody.